Hey guys, welcome to another Trade Genius podcast. Philip here, Bob's still on vacation. Guys, we need to take a look at the jobs data. The chart I'm going to show you is going to be pretty telling. You're not going to want to miss this. I'm also going to take a look at the S&P 500 because I want to show you guys where I think we are headed. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
All right, guys, so we got a busy week. Tomorrow we have the Fed announcement, if they're going to raise rates or not. We also have the quarterly funding announcement from the Treasury. What that is that tells us how much they're going to issue of either long-term debt or short-term debt. Short-term debt is typically T-bills, and they've been issuing a ton of it. And the reason why that matters is because T-bills is typically used for collateral to make levered bets in the system by these institutional players that are taking on those T-bills. If we are issuing a ton of T-bills, it's fuel for the market, and Yellen effectively creates her own form of QE or quantitative easing, providing liquidity for the markets. And that's effectively what's been pumping these markets up since the debt ceiling was raised last year. So if she comes in tomorrow morning at 8:30 a.m. Eastern and says, hey, I'm pulling back on the amount of T-bills I'm issuing, then we might see a negative reaction in the markets in the short term. That being said, we are in that window where we start to head toward that OPEX date for the month, which is in a couple of weeks, and that typically gives us tailwinds. I also want to take a look at jobs data. Now, the first chart we're going to look at is jobs opening, and I want you guys to look at how job openings compares to previous examples of where jobs started to roll over before the market did. Here is the current examples. And if you look back in 2008, again, pre-recession, we ended up, I know it's hard because of the scaling, but we ended up holding up in the market, trying to go higher while jobs were slowly rolling over. And then things started to accelerate and the market caught back down with it. And we had recession. COVID, you'll notice we had, actually, this is before COVID, similar situation where jobs started rolling away from the market gains and then sharp reduction as COVID hit and things were shut down. Again, I think COVID was cover for underlying issues in the economy, and a lot of money printing truncated what probably would have turned into a recession at that point. Now let's fast forward to the right of the chart where we are today. Miraculously, this market acts like it's cured all forms of cancer, and it's having one of the strongest rallies that we've had in a long, long time. And yet look at total non-farm job openings, right? Really on a terminal decline here. Now, true, we had an uptick in that, but I mean, if you look at the overall structure of job openings, unless we have, month over month over month of an improvement in that, we're basically looking at a situation where the job market is drying up. And as we've said, that's really the missing piece in terms of all of the recessionary data points that we have for a recession. Now, again, most of these markets will tend to go up right before a recession, and that leads me to this chart of the S&P 500. So guys, if we look at the S&P 500, I drew some fibs here. This is just really simple fib stuff, the 50% and the 618. That's generally kind of like your golden pocket for when you get pullbacks. And I wanted to zoom in here. I mean, you can see on a weekly chart, right? The trajectory of the candles here on the weekly are getting into this mode like we saw back here as we were grinding up after COVID. It's almost like QE is in effect here. And like I said, this is largely because of what Yellen has done with the T-bills. So the issuance matters. We're going to know that tomorrow morning, 8:30 a.m. Eastern. And we'll talk about that on tomorrow's podcast as to what happens. We also have the Fed announcement for rates, which we think, rates will probably stand pat on this decision cycle. And I think the one that's really up in the air is the next meeting that we're going to have. That's sometime in March, and we're going to get a decision on whether or not they decide to cut. But if you look at everything, if you look at jobs data currently in terms of unemployment, GDP growth, and retail sales and things like that, I think it's hard to make a case that we are due for a rate cut, even though the market seemingly wants to price that in. It just doesn't make a lot of sense here. But back to the chart. Here we have this grind up. You don't really want to get in front of this move unless it gives you an excuse that we have some structural weakness in the chart. We just don't see that. If we pull the fib from the COVID low to the recent high we had going into January of 2022, that is a fib extension on the S&P 500 at 5324. All right. So that's another 400 points higher. And for this market, that's really not a stretch. I mean, if you look at what we did coming out of October, just a few months ago, right? 4126 to 4922. I mean, that's just about 800 points higher in a relatively short amount of time. So to get up there, is not asking too much for this market. If you really get like a blow off squeezy top, then you can look at the 618 extension, and that's up there at 6441. That might be a stretch, okay? But getting to 5438, that to me seems reasonable. If you look back in prior times that we've had these moves up, these types of runs where you get these bunch of weekly candles that aren't huge, but they're just grinding. You look at what we did here off of December 18. This was coming into the end of December. We had some structural problems in the market, quickly recovered. But if you pull off that initial leg, not only did we get the 236, but we also got the 618 off of that. So you can get these higher fib extensions as these markets kind of do their final squeeze. But you'll notice after they hit that 618, pretty catastrophic drop. If we get such a blow off move, I would suspect that the jobs and the job openings data really starts to go south. And I think you're going to see unemployment tick up. And maybe it's even a backward revision to that and GDP that really kills this market, because at that point, the valuations don't make sense. The forward looking growth won't be good. And the market is going to be deemed very expensive by algos and investment formulas. And you're probably going to see a decent run into the bond market. And that's where we're going to see that TLT go up and the markets go down, that big divergence. So risk on assets are going to take a beating. So guys, that is something that we have to keep an eye on. Again, right now, there's nothing in the market structure that's telling you to go short here. You're going to want to see a breakdown and a market structure shift lower. And basically what that means is starting to take out some of these swing lows and really a failure to gain acceptance over one of those breakdowns. And that's where you're going to see this market start to falter. You typically see a lot of more volatile moves also at the end of when these markets are done squeezing. You get more of this type of behavior, not these little weekly candles that grind. You're going to see some large gyrations come in. And that's typically how markets will top out when they're not dealing with basically a structural failure or credit crisis or something like that, something that just comes in out of nowhere and just breaks things. If it's just really the market is starting to get tapped out, then typically what we see is like these tops that we get as we did before the great financial crisis, where you get these series of peaks, right? And then a lower high and then things roll over. So things weren't breaking here, but they did start to break here after the drawdowns were too great. So if we don't get like the break in something, credit crisis or something like that, this is typically how markets organically roll over. You can see that here in the 2000s too, right? You get these grindy candles on the way up, but then as things top out, you start to get these little Eiffel Tower effects. You'll see this in a market like Bitcoin as well. And that's things that you really want to look for. So if we do start seeing that sort of widening in the weekly candles, then we need to know that we have to be on guard. We could potentially be seeing a final topping formation. So I just wanted to show that to you guys, kind of give you a bigger perspective on where we are in these markets. But look, if this thing does get up there, remember, there's a lot of assets that aren't at their all-time highs. They could play catch up here. Bitcoin is one of them. You got to be open to the idea that maybe you get an all-time high. But again, this cycle could be very, very different. If this is a blow-off move ahead of a recession, I think Bitcoin's going to do some things that it hasn't done in previous cycles. We've already seen that as we dipped under the previous cycle all-time high. That is something that was new for this cycle. So I do think we're running into an era where things are just a little different. We're looking at a sample size of 3 on an instrument like Bitcoin as well. So you can't just say just because we had 3 cycles that rotated around the halving that's just going to be what we do this time. Statistically, that sample size is insignificant. So we have to look to the macro here. And I think that's really going to affect Bitcoin, because if we're relying on like things like ETF inflows, institutional inflows, those are going to rely on an economy that is continuing to expand and grow. And if we start getting a turn down in this jobs data, and I think the job openings, if you look at that structurally with the market, I think that's giving you another big warning flag here. And we have downward revisions in, say, GDP. All of these things are going to affect the inflows, even in something like Bitcoin, where you have ETFs. And long term, it's going to be, I think, unstoppable. But it's just another risk on asset at the moment. Unless somebody gobbles up all the float and all the remaining supply on the exchanges, then you get supply shock. But again, I think it's more along the lines of the realistic look that it's a risk on asset at the moment, and it's going to require a lot of flows to continue. So in the interim, things could get very squeezy in these markets. I think seasonally, we have to be cognizant of the fact that middle of February to middle of March is really dicey. And I think with the amount of leverage that we have in the system and the way things are moving at the moment, we could see a week or two pullback in the market. But when we're in this mode, those dips should be aggressively bought. So we're going to continue to monitor this, keep you abreast of it, but that's what's going on. Let's see what happens tomorrow with the quarterly refunding announcement and the Fed decision, and look at the market reaction after that, and we'll talk about it then. Guys, thanks for watching. Please hit like and subscribe. If you need help navigating these markets, check out our stuff over at tradegenius.co. You can get into the room with us and be around with other traders, bouncing ideas and getting our input as well. We'll see you on the next video. Take care.
Trade Genius.